Welcome to Coverage and Clarity with Jacques, the podcast where we break down protection, planning, and peace of mind so you can make confident decisions for the people who matter most.
Welcome to Coverage and Clarity with Jacques. This is where we slow things down, remove the confusion, and focus on what truly matters, protecting the people you love with confidence and understanding. Now, today we're talking about something that most adults avoid. This episode's for the 22-year-old who just started their career, the 27-year-old entrepreneur who's building something from scratch, the newly engaged couple who are planning for their future, and even the parent listening who wants their adult child to make smarter financial decisions early. Today I'm giving you life insurance tips every young adult should know. This is not sales talk, this is not theory, but strategy. Because life insurance isn't about death, it's about leverage, it's about insurability, it's about protecting your future earning power. Now let's get into it. Let's start off with cost and insurability. The younger you are, the cheaper it is. Price for life insurance is built on actuarial tables. The younger you are, the lower the statistical risk of you passing. The healthier you are, the lower the statistical risk of passing. What that means to you is lower premiums. So a 25-year-old can lock in rates that will stay level for the next 20 or even 30 years, all for a fraction of what they pay at age 35 for the exact same coverage. Your biggest financial advantage is time. Let's use it together wisely. Now, your health today locks in your future. Your health classification is determined by several things. Determined by your blood pressure, your cholesterol, your family history, your body build, and tobacco use. Now, you cannot control aging, but you can control when you apply for life insurance coverage. Remember, yesterday's already gone. There's nothing we could do about that. Since we cannot turn back the hands of time, today is when you should add that additional policy, because tomorrow is not promised. Now, when tomorrow does come, though, coverage will be more expensive because you'll be older. To help the younger generation, what you should do is encourage them to get coverage for themselves sooner than later. They'll definitely appreciate this from you. Now, a gamble that many people do is wait to get coverage after a medical diagnosis. Now, the present time is the lowest you'll ever be able to get that policy for yourself. So let's not gamble on that. Now, waiting is the most expensive decision that you could ever make in life. Let me be direct with you. A delay can permanently increase your premiums for decades. Even if nothing changes with your health, your age alone will increase the cost. Procrastination is expensive, especially when it comes to life insurance. Now, one thing I always say to each and every single client on an application is be honest. The reason for this is because there's something called a contestability period. If a material misrepresentation was knowingly made on an application, a claim could be denied within 2 years of its issue. Now, full disclosure protects your family because integrity matters here. All life insurance policies state the following. Anyone who knowingly presents a false statement on insurance application is guilty of a criminal offense. Now, that is subject to penalties of state laws that could lead to jail time. Now, it's not worth you going to jail to save a few dollars here and there. Now, there are many other factors that affect your life insurance policies. First one being hazardous occupations or even hazardous hobbies. By disclosing hazardous hobbies or occupations, you'll get an accurate premium and avoid any future claim disputes. Now, don't try to hide these facts because they could affect your coverage in the long run. For example, if you bungee jump or skydive regularly, this gives a carrier reason to reevaluate that particular claim before paying it out to the family if you should die within 2 years of issuance. So if you do this regularly, let them know. They'll adjust it accordingly. At least you know that no matter what happens, you're fully protected from day one of coverage. Next, using tobacco and vaping. Now, your history of tobacco products and vaping could significantly raise your premiums. Now, tobacco products includes everything from chewing tobacco to cigarettes, to cigars, to even vaping. With some carriers, if you stop for a period of time, they may even reconsider your smoking status, thereby providing you with the most favorable rates possible based on your situation. Remember, on-the-job group coverage definitely helps by having it, but definitely consider participating with it if you do get it offered to you. But don't rely on this as being your only source of coverage. You'd be surprised how many people say, yes, they do have life insurance, but only on their job. The job only pays if you die while you're on the job. And I hope that you're around much longer than that so that that will not be what you depend on for your family in the event that you should pass. So I would say if you had none, now you have a little bit. If you already have life insurance, now you have additional coverage while you're working there during your working years. Now recognize group life insurance covers end when you leave the job. Having your own policy will give you portability. What I mean by portability means it's your policy. No one can take it away from you. As long as you make your payments and continue to pay it, you'll have coverage for life. This is why you want to get at least a whole life policy that you could have that. Or if you get a term policy, at least you're covered for the time period that you own it. Understanding the types of coverage. Permanent policies, as I said, builds cash value. With this cash value, you could borrow against it or withdraw under certain conditions. Now, be cautious when borrowing from your policy because it will reduce the death benefit and may have tax implications for you. Now, consider term policy for income replacement. What this means is if you were to pass, you want to have at least 10 to 15 times your annual income for your family. So the term policy will definitely cover that. That will give your family time to get back on their feet upon your loss. Consider permanent policy for estate planning or business needs. Now, speaking of business needs, if you own a business, what you should do is explore a buy-sell or a key person insurance to protect your operations. Now, what a buy-sell agreement does, it allows you as a business owner to insure the other business owner with you, your co-business owner, so that if either of you should pass, the money that's from the life insurance will help run the business. Because the one thing that one business owner does not want to do is to go into business with the other person's family. So by having a buy-sell agreement, if one person should pass, the other business owner will definitely get the money and they could do whatever they choose to, whether it be to get a new partner or use that to help run the business. Now, key person insurance is the important person on a business. It could be the accountant for the business, the president for the business, whatever that key person is. By having a key person insurance on them in the event of their passing, this will allow the company to continue on while they look on for someone else to replace them. So either way, the business will continue running smoothly. So this is why any business owner should have a buy-sell agreement for themselves, as well as key person insurance for the person in their business that helps run it. Now, remember, your debts do not die when you die. If you have student loans, you should know that your co-signer will become responsible for your loans in case of your death. Now, the life insurance will help cover that. So you want to make sure that you coordinate it with emergency savings, retirement, and any debt management, because these are all things that your life insurance will cover. So you want to make sure that that's all fully done at any time you have any loans with a co-signer. You want to make sure you name your beneficiaries wisely. Name both a primary and contingent beneficiary to avoid probate complications. Now, your primary beneficiary is the person or persons that you choose to take the funds upon your passing. They're the primary people for that. That means that they will take care of your funeral expenses. They'll be the ones you leave the money to, etc. What a contingency beneficiary does, in the event your primary beneficiary should predecease you and they're not around, they in turn will inherit the money that was left by you. So you always want to make sure that you have a primary person, and in the event he or she's not there, a contingency person to make sure that they get the funds. Therefore, the money will not go to unclaimed funds, and you know that your wishes will be taken care of, mainly being your funeral expenses and who you want to leave your money to. What you should always do is educate the beneficiaries about the policy and how to file a claim when this happens. Now, many people say, okay, they have a beneficiary, but the beneficiary doesn't know that they have a policy at all. So when the time comes, someone needs to put a claim out. If the insurance company doesn't know that you passed, no claim is paid, and therefore that money will go to probate. This is why you should always let your beneficiaries know that you do have a policy and explain to them how this works. This is one of the reasons why I do annual reviews, not only with my clients themselves, but their beneficiaries if they choose to. Therefore, everyone knows what needs to be done if and when the time comes to make sure that everything runs smoothly as possible. So by me reviewing with them on an annual basis, at least they could add more coverage if need be. The beneficiaries, I could meet with them directly as well, and even insure the beneficiaries for their own policies. So this is all reasons why you want to make sure the beneficiaries know that your policies are there in existence. You want to keep your beneficiary designations up to date after major life events, such as a birth, a marriage, or even after a divorce. Now, you'll be surprised how many people do not change their beneficiaries after divorce. So now what happens is the ex-spouse is the one who gets the money, while the new spouse may not. So this is why you always want to make sure on your annual reviews that you review your beneficiaries and update them as soon as possible. So by reviewing your policy periodically, understand two main types of things happen. You make sure that everything's up to date, and then you're sure that you have the right amount of coverage. Now, one of the things that I go through on all annual reviews is to make sure that you understand the two major types of policies. Your term policies, which will cover you for a set period, 10 to 30 years, which may be covering the mortgage, for instance, making sure there's excess money there for the children if they're still of school age. And then with your whole life policies, make sure that that lasts for a lifetime. As long as payments are made on it, you will have the cash value as well as a policy to last a lifetime, no matter when a person passes. So as I mentioned before, reevaluate the coverage if you get remarried, get divorced, have children, or change careers. Make sure that the policy still fits your needs. Keep a copy of your policies and store the contact details in a secure, accessible place for your beneficiaries to find. Now, be sure to use my family data guide and last will and testament, which I provide to all my clients. By doing so, you know that all the information is clearly listed and they know where it is. One thing I always tell everybody is understand the structure of their policies. Because remember, not all policies are built the same. The term policies will protect you during the high responsibility years. This is the window of time, 10, 20, or even 30 years. It's designed for income replacement, meaning that if you're gone, at least your family will have the income that you would have provided for those 10, 20, 30 years going into the future. Mortgage protection. In the event of your passing, you want to make sure that your family keeps the roof over their head and not lose it. So with the term policies, it'll make sure that the mortgage is paid off immediately upon your passing. Raising children. If you have minor children, you want to make sure that they have money for at least college or maybe even a little past that point to make sure that they get their lives on track as well. This is why you want to make sure that you have coverage for that. And debt coverage, as I mentioned before, any debts you have still need to be paid, whether it's student loans, car loans, mortgages, or other credit card debts. You want to make sure that that's all covered. This is where your term policies come into place to make sure that they cover these what's basically incidentals, but stuff that everyone has and then you have every single day in your life. So what it does, it gives you maximum coverage for minimum premium. So term policies in this case, it's very efficient. Now your whole life policy, as I told you, is permanent. It'll cover you for your entire lifetime. It'll build cash value. Your premiums are fixed. Your death benefits guaranteed. And your cash grows tax deferred. This is what we call stability in your insurance. Now, as I mentioned earlier, your employer coverage does not give you ownership. Group coverage works through you being there on the job and passing while you're there. It usually pay about 1 to 2 times your salary. And if you leave your job, coverage ends immediately. The same day that your last day is there is the same day your coverage occurs. So remember, you do not own it. With personal coverage, you have total control of it and it's portable. It is yours to take with you. It's yours no matter what job you have. The only thing you have to be responsible for is continuing payments. You continue payments, you have the policy for life. Now, one thing I always tell people is learn to use your life insurance policy strategically. Now, let's elevate this conversation that I've been having with you. Life insurance is not just for protection, it could be a lifetime strategy. Now, understand, permanent policies have a cash value and a death benefit. Now, the death benefit is what your beneficiary receives. So if you have a policy for $50,000, $100,000, $1 million, whatever that is, that's what your beneficiary will receive upon your passing. Cash value is a living component of your policy that you have control over. Now, with a cash value, you can use it for whatever you want to. You can take loans against it. You could borrow against it. You can let it grow. You can use it in retirement. So by having that, especially on an IUL, an Index Universal Life, where you get bigger cash value within your whole life policy, you could use that for yourself while you're alive. But once you pass, the only thing that the beneficiaries will get is the death benefit minus any loans equals what they receive. So remember, they are not the same for all parties. So this is, therefore, I always explain to people exactly what the difference is between the cash value equivalent that the owner uses and the death benefit that the beneficiaries use. Now, permanent policies could be used as a financial tool. Now, used properly, it could support your retirement. As I mentioned, you could use the cash value in your policy towards your retirement to use in addition to anything else that you may have, a pension, Social Security, other benefits. Business planning, as I mentioned earlier, key person insurance and buyout insurance, meaning that if anything happens to you as the owner of the business, money will fund the replacement for either a buy-sell agreement or key person insurance to help keep your business running. Estate liquidity. This is where you have access to funds, basically your cash value that you as the owner could use while you're alive. And of course, wealth transfer is when your beneficiaries get the funds that came from your life insurance policies. So these are all stuff that's in there. So you want to structure everything. And by structuring everything, it becomes a powerful if used properly. Now, what a lot of people don't realize, life insurance policies have living benefits. Now, with the living benefits, you could have an accelerated death benefit. What that means is if the doctors deem that you have less than 12 months to survive, you can use some of your death benefit while you're alive. Now, someone would say, why would I want to use a death benefit while you're alive? Well, you could use that to spend time with your family. Make sure you take that last vacation trip together. Make sure that debts that you may have outstanding are paid for so that when the time does come, what's left over from the death benefit goes directly to your beneficiaries to pay for either your funeral itself or to leave for them if you already use money for that on a pre-planning your funeral payments. So this is how it helps you throughout. So that's protection beyond your death. You can use it while you're alive as well. Now, one technique I teach my clients is what's called the DIME formula. D is for debt. I is for income replacement. M is for mortgage. E is for education. What you do is you add all those numbers together, the total debt, how much money you want to leave to replace your income, the mortgage amount, and any education fee that you want to leave for your children. This gives you a realistic number of how much coverage you need. This is not a guess, but instead a real calculation to go by. Now, based on either the amount of money or the amount of time you have, you could build up to getting the full amount, but at least you know what your full amount of coverage would be if you had it all to do today. Show real life responsibilities. Now remember, debt does not go away if you die. So this includes any student loans you may have, any cosigns for car loans, any cosigns for mortgages, any credit obligations. Someone's still responsible for all these debts. This is why you need to plan accordingly to make sure your life insurance covers these debts so you do not leave these debts to anybody else. Now, if anyone depends on you, such as a spouse, a partner, a child, or even an aging parent, your income needs to be replaced. And this is why you want to make sure there's enough life insurance to do so. Now, many people think that being single is no reason to wait to get insurance. Remember, your insurability is an asset. The younger you are, the healthier you are, meaning the cheaper it is to get your policies. Because remember, on actuary tables, the older you are, the more expensive it becomes. Locking in your rates before marriage or children gives you flexibility later. So while you may only pay, let's say, $100 today, you'll be paying 5, 6, 7, even more later on for the same amount of coverage. The earlier you get it, the better it is. You future-proof yourself as well. When are you most healthy? The younger you are and the earlier you get it. So that no matter what happens later on in life, whether it be health conditions, age, whatever that may be, you just get your policies at a very affordable rate for yourself. Remember to keep your beneficiary designations up to date. Life insurance could bypass probate if structured correctly. What I mean by this is if you don't have beneficiaries there and you pass, that money, as I said, goes to the state, in which case the attorneys, the court system will determine what goes to who, where it goes to, how much, etc. So to avoid all this, you want to clearly list who your beneficiaries are. So upon your passing, the executor will make sure everything's passed out to the beneficiaries and all that goes smoothly with no court interference. Outdated beneficiaries also create a problem. Review them regularly because especially after a marriage, after a divorce, or after you have more children, you want to make sure that everything is up to date. So plan accordingly. Now, what I tell everybody is to review your policies regularly. This is why I do my annual reviews, because what's uncovered doing that is finding out about marriages, finding out about your children, whether your income has increased, whether you purchased a new home, whether you owned and acquired a business. The coverage should grow with you as well as your responsibilities. What you do is build in layers. Many young adults benefit from a layered approach. The base term policies covered a large amount for a smaller premium and gives you flexibility. Know that you can scale over time. Now, building a foundation first will allow you to know what coverage you have, and as time comes, you could add more to it. This is when you expand. Now, I want to leave you with this. The biggest mistake young adults make is thinking life insurance is only about death. It's not. Life insurance is about financial maturity, responsibility, strategic positioning, and protecting your future earning power. Time is only on your side today, but only if you act while you have it. Now, this is Coverage and Clarity with Jacques, where protection meets understanding, and understanding leads to confidence. If this episode added value to you, share with a young adult who needs to hear about it. And if you want clarity on your specific situations, schedule a consultation with me. Now remember, I provide coverage to clients nationwide. To contact me, call or text the studio at 631-594-8118. That's 631-594-8118. Now remember, protect wisely, plan intentionally, and I'll see you next time.